Hi, welcome to our installment of Live at Noon. This is Dee Dee Jones, and today we are talking about inheritances and taxes. And the big question, if you have an inheritance, will it be taxable? Well, you'd think it'd be simple, but of course, like anything related to taxes, it's anything but. In fact, there are multiple levels of tax that we need to think about when we're talking about the taxation of an inheritance. The first thing I want to talk about is, are you going to deal with an estate tax? So an estate tax is actually not paid by the person inheriting the money. It's paid before that money leaves the estate of the person who died. They call it the decedent. So first of all, remember that we have a really high exemption rate for estate taxes. Let's see, this year it's $11.58 million per person, and married couples can actually combine that together to double it. So if you have an estate when someone dies that's over the $11.5 million, or the second to die in a couple if it's over that $13 million mark, the monies or the value in excess of that exemption are going to be subject to federal estate tax. Now, the inheriting people won't be subject to it, but the estate is. So that's a big thing to keep in mind when you're talking taxes about inheritances, because we also have something called an inheritance tax. So an estate tax paid by the estate, inheritance tax paid by the inheritor. Now, it used to be we saw lots of inheritance taxes across the country. We're actually down to around a dozen states that have inheritance taxes. If you're in Washington, Oregon, Minnesota, Illinois, New York, Maine, Massachusetts, Rhode Island, Connecticut, District of Columbia, and a very special place of Maryland. I'll tell you why that's special in a minute. They each have their own estate taxes on top of the federal. So, and they each have their own separate limits. I won't bore you with going through that list, but if any of those states are relevant to you, there is an estate tax in that state. Now, the inheritance tax is a different animal. The people who receive the money pay the tax. So if you die in Nebraska and the inheritors live in Nebraska, there's no inheritors tax. But if grandma dies in Nebraska and you live in Colorado, say, there is an inheritance tax that you, as the inheritor, will have to pay. And so they have different rates for that. So the remaining states with inheritance taxes are Nebraska, Iowa, Pennsylvania, Kentucky, New Jersey, and Maryland. Remember I said they were special? Maryland is the only state right now that has both an estate tax and an inheritance tax. And by the way, I missed on the estate taxes. We also have Hawaii that has estate taxes. So that's the first cut of taxes we talk about when we're thinking about taxation of an inheritance. Okay, so inheritance tax, estate tax. Estate tax is the big one that most people think of, but inheritance tax can come into play. So the next thing is, once you've inherited and paid the taxes based on the death, what do you have then? So imagine that it's a stock. We have to actually talk about basis. Let's talk about who gets a step up in basis when we're talking about, say, stock or a company or a house. It can be any number of things. So the first thing we need to know to start understanding this is, did you inherit from your spouse? And if you did, there's two sets of rules we have to look at, and it depends on the state that you live in. So there's what's called a community property state, where all assets that are generated through the life of the marriage are deemed to be owned by everybody equally. Those are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. Those are the community property states. Those have separate rules. And so if you lived in one of those states, the next question we ask is, what is it that you inherited? Because if it's an IRA, 401k, pension, annuity, or even an irrevocable trust, there is not a step up in basis. If it's something other than that, both halves of the inherited property will receive a step up in basis. So the community property states have a leg up. We'll come to what I mean by that here in a minute. So you may be asking, step up in basis, Dee Dee, what on earth are you talking about? Great question. So my favorite example is, imagine grandpa bought IBM way back in the late 50s, bought $100 worth of it. and didn't do anything with it. It just sat and cooked. And all of a sudden today he's passed and you are inheriting that what was paid for by $100. Imagine it's $100,000 in value now. I don't know what it is. One of you really smart folks out there can go look that up. But for our purposes, it was purchased for a very small amount. It was sold for a very big amount after at the point of Grandpa's death. So what happens is if you inherit that, you get what is called a step up in basis. So if Grandpa had sold that stock a day before he died, he'd pay capital gains tax on the difference between the $100 and the $100,000. So that'd be a lot of tax. On the day he passes and that stock goes to you, the new basis is now the value at his death. Generally, there's an exception to that, but generally that's what it would be. And if you sold it right away, you wouldn't have a tax burden. So that's really kind of a nice, I don't know if it's a gift. I'm not really sure the genesis of it in the tax code, but at death, there is a step up in basis in many, many cases. I think that it had to do with it was very hard to track what people paid for stuff in the past. That's changing. So as technology changes, taxes have a tendency to change. So that might not stay the same into the future, but that's what we care about. So basis is what you paid for something. We pay tax on the difference between basis and what we sell. That's what an accountant would call gain. So the higher you can get your basis, the better it is for you. So let's walk through what happens if you don't live in a community property estate and you inherit from your spouse. Again, we look to see if that property is coming from a tax advantaged account, basically IRA, 401k, pension, or irrevocable trust. If it does, there's no step up in basis, but if it doesn't, then we have to look at the valuation date. Remember, I said generally it's the date of death, but the executor, the person handling the estate of the decedent, can choose an alternate valuation date, which is 6 months after the date of death. So we can set that basis value either at the date of death or 6 months later. And when things get this fancy, there's probably attorneys and accountants involved. So yay. Don't we love that? That's awesome. So the question, if you're going to use that alternative valuation date, was the property sold before the alternate valuation date? And if it was, you just use the value at the date the property was sold. Say they died in January, you're going to use the June valuation date, but you sold it in March, you just use the value in March. And so that makes that pretty simple. We also have to look at the titling of the property. So if it's just simple single ownership, the full property receives a step up in basis, in cost basis, based on the fair market value, based on the date of death or the alternative valuation date. Here's the trick. Here's where the folks not in community property estates don't get quite as good a deal. If you own property jointly, joint tenants with rights of survivorship, you probably are familiar with the JTWROS acronym. Only half of the value receives a step up to fair market value based on the date selected earlier. But full ownership does pass to you if that's how you inherit. And then finally, we have tenants in common. We don't see this as often, although I do see attorneys use this for their own families for good reasons. That just means things don't pass automatically. I own half, somebody else owns half. Whoever inherits that other half, they get 100% of the decedent's share stepped up to the fair market value at the date chosen. And ownership has to be proved. And so those are the rules that come into play. There is one exception I want to mention. If you inherit something that you had gifted to that decedent less than a year ago, there's no step up in basis. So let's see. So say, I can't even come up with an example for this one today, but just if you're giving away property as end of life planning, know that there's certain dates you need to follow. And it won't necessarily work if that person dies before that 1 year passes. You will lose that step up in basis. Still a valid strategy, certainly something to try, but sometimes we can't predict the future. So taxation on inheritances is complicated. We start with a look at what happens at the point of death, where you have an estate tax, and maybe at the state level, an estate tax and or an inheritance tax. And then we look at what you receive as part of that inheritance. If it's a tax preferenced type account, IRAs, 401ks, pensions. There's no step up in basis. Everything's going to come to you as ordinary income in all likelihood. Other items, we set a value based on the date of death or that alternate 6-month date, and that's your new basis. So someday when you choose to liquidate that investment, you just pay the taxes on the gain above that step up in basis and the new price you sell. Hopefully that there's a gain because you're going to be a really wise, excellent investor. So complicated topic today. Glad you were able to join us. If you've got more questions on whether or not your inheritance will be taxed and by how much, please reach out to us here at Innovative Financial. This is Dee Dee Jones. Glad to have you with us here today.